Diversification means different things to different investors. Many mutual fund advisors tout that diversification is best achieved by buying an index or basket of 100 or more stocks through some type of fund. Others in the expert arena, such as Jim Cramer, Joe Terranova, or Phil Town, suggest holding a handful of stocks that have been personally selected. So how do you create a diverse portfolio of investments that provides both upside potential and downside protection of your wealth? For the avid stock investor, let's take a look at 7 key factors to integrate into your investment portfolio in order to create an appropriate level of diversification. Diversification across asset classes. The first type of diversification to build into your overall investment portfolio is across asset classes. As a lifelong investor, your ideal investment portfolio should contain not only stocks but also investments from other asset classes. By investing in other asset classes such as real estate rental property, commodities like oil and gold, systematized businesses that run on their own, or fixed income investments like bonds, you spread out your risk across various markets. I have been a big advocate for investing in assets that generate a consistent cash flow into your overall portfolio. Look for opportunities that reward your investing efforts on a regular basis with an injection of cash into your accounts. Like they say, a bird in the hand is worth 2 in the bush. Besides having invested in the stock market and real estate over the years, I have also dabbled in the precious metals sector. Several years ago, as part of an angel capital investment project, I participated in the expansion of mining operations in Central America just at the time when gold was on its incredible run-up in price. By looking for opportunities across several different markets, when one market is trending lower, another unrelated one may be heading higher. Investing in various asset classes creates a better balance in preserving your overall capital and should be one of your long-term investment objectives. Most self-made millionaires use a multifaceted approach to wealth creation, and so should you. Diversification within the stock market. When you invest in the stock market, your portfolio may benefit from being invested in various groups of stocks that are classified by size or characteristics. For example, you may decide to invest a core amount of your investment capital in dividend-paying large-cap stocks, with a smaller percentage of your capital being spread across the small or mid-cap stock universe. Each group has its own unique characteristics that benefit from certain market or economic conditions. At times, you may find that your investments in the small cap universe will prove to be winners in a booming economy. At other times, your dividend-paying stocks may outperform the small or mid-cap stock universes. By diversifying your capital within the stock market, you can benefit from the changing tides that naturally occur every 4 to 5 years. Diversification across the 10 economic sectors. A popular way of grouping companies traded in the stock market has been to place them into 10 economic sectors based on the nature or purpose of the business. Examples of these economic sectors are the technology sector, consumer staples, energy, utilities, and healthcare. Allocating no more than 20% of your investment capital to any one of the 10 economic sectors provides you with better balance. As one economic sector goes out of favor with Mr. Market, another will quickly take its place. This can be seen by taking a quick look at a technical chart of the various sector exchange-traded funds known as SPDRs, or Standard & Poor's Depository Receipt Funds. You will be able to visually see changes in each sector over a 3 to 6 month period of time, thereby giving you some additional insight as to what sectors are trending higher the most. Spreading out your capital improves your odds of overall portfolio growth. Once you have a number of good investment candidates on your watch list, you should be aware of how you allocate your capital across the 10 business sectors. Diversification across the globe. Although the US has the most vibrant stock markets in the world, you should actively seek out companies that have a global exposure. This can be done with US-based companies that export more than 30% of their goods or services overseas, or through ADRs, which are foreign companies that trade on US exchanges. Look for the tag ADR, which stands for American Depository Receipt, after the name of a company you are researching. Consider exposing yourself to Canadian companies in the financial sector or base materials. Canada has a commodity-based economy and one of the strongest financial systems in the world. Also take a look at the BRICS countries, Brazil, Russia, India, China, and South Africa, whose growing middle class are buying more and more local products and services, not to mention those of the international players. To start with, focus your attention on US and Canadian companies with international exposure, as well as those foreign businesses listed as ADRs on the US stock exchanges. Diversification across time. By investing on a regular basis, you are able to tap into opportunities as they present themselves. Having cash on hand to take advantage of mispricings in the market allows you to buy into positions with a certain margin of safety. It is the velocity of your money through the stock market from one investment to a better one that accelerates your wealth building potential. The old adage of buy, hold, and forget no longer works in today's markets. You may be better served by moving your dead money into growth opportunities on a regular basis. By constantly seeking investment opportunities that focus on accelerating your cash flow generation, you position yourself to quickly build wealth over a shorter period of time than those who do not actively manage their investments. Imagine being able to double your money every few years, allowing you to realize your dreams that much sooner just by knowing how to move your money into and out of better and better opportunities. Diversification across investment accounts. Not all investment accounts are created equal. A few allow you to grow your investments tax-free, others defer the tax you pay, and some offer better investment choices. You should try to diversify your holdings across 3 general types of accounts because of the advantages and limitations of each. Many employed investors are familiar with the 401k, or the RSP in Canada, which creates a tax deduction up front in return for taxable income once the money is withdrawn at retirement. When employers are matching your contributions, it makes sense to take advantage of the match-up to the allowable maximum set up by your employer. The Roth IRA, or the tax-free savings account in Canada, are tax-free accounts in which investment capital that has already been taxed can grow and compound over time to be used tax-free at a future date. A big advantage of self-directed IRA accounts is that they have many more investment choices beyond just a small selection of mutual funds, ETFs, or bonds typically offered in 401k accounts. Finally, an individual margin account allows you the greatest investment choice flexibility from stocks to options to commodities plays. This type of account gives you greater control over making money whether the market is heading up or everyone else is panicking in a sell-off. Diversification across investment strategies. It is well documented that some investment strategies work better under certain economic conditions than others. Consistently using a few time-tested solid performers will help to boost your overall returns. Your challenge is to select those time-tested investment strategies that will accelerate your wealth creation in the stock market. Consider those approaches that allow you to layer on different strategies that compound your wealth-building efforts. For example, by selling covered calls on dividend stocks that you already own, you can tap into the cash flow that can be generated from both the dividends and option premiums that you receive. In the hands of a capable investor, layering one cash flow position onto another is a great way to quickly accelerate your wealth creation through the stock market. As you can surmise by taking into consideration these various diversification factors, you will be in a more solid position to protect your downside while generating more consistent returns in the future. To learn more about the wonderful world of stock investing as a do-it-yourself investor, I encourage you to visit us at Stock Investing Simplified. To your ongoing success as an investor,